There is a different couch behind me. You are not seeing things. Too long of a story to get into. But Matt, this is a really interesting day.
Is it?
Do you know why this is an interesting day?
Because you actually bought VG instead of just talking about it.
Well, we'll get into that in a moment. But it's an interesting day because we're at 6,906 on the S&P.
That means we're 1.1, 1.2 away.
1.36% away from S&P 7,000. I think we're going to get there. Now, I am not going to say we're getting there this week. That would be irresponsible. But don't tell me that we can't get 1.36% in the next 5 trading days. You know what I mean?
Steve, I think you're right. I think you're onto something.
I think Santa's coming. I think he's coming. He's going to bring me cookies.
Already came? You don't think he already came?
Big S&P.
What kind of cookies is he leaving out for you, Steve?
You know, I don't know because that's up to Santa. But I got to tell you, Santa better be leaving me some cookies out tonight and tomorrow night.
2% or whole for the milk?
That's not even a question, sir.
Whole milk?
That whole milk. Thank you, everybody, for being here. Really appreciate it. I see Chels is done traveling, got to her destination safely. She's here. June is here. Thank you, everyone. Really appreciate it.
The J-Bug, as some may call her.
We're going to hit 7,000, I think. I'm ready.
I'm watching.
I'm ready.
I'm waiting on it, staring on it. It's like I'm waiting for Donald to call.
So, did you see the headlines today, sir?
No, I've been running around making plays today, so let me get into it. Wow, we are actually on a nice little trajectory, up 0.44% today.
Well, I have an issue.
Almost at all-time highs.
That I am taking care of while we podcast. I should turn my ringer off.
Almost at all-time highs. Issues, is it bad or is it just a slight issue?
Just because you take a day off from work doesn't mean you don't work, okay?
Steve, you tell them, wait until tomorrow.
Anyway, all right. We had a blowout GDP number, Matt. Blowout.
I didn't see that. No, I didn't.
Are you ready? Good thing you're sitting down.
Was it the 25% that Donald J. Trump wanted?
Good thing you're sitting down, sir. I'm about to tell you.
4.5.
4.3%.
Get the fuck out. No way.
Versus 3.8% in Q2. 4.3 freaking percent.
I mean, now, you throw in a bunch of capital expenditure and numbers go up. I guess it makes sense.
What the people are saying is GDP rose on consumer spending, exports, and government, which was partly offset by a decline in investment. Imports fell, which mathematically the people are saying boosts GDP via net exports. Now, consumer spending, PCE, 3.5% in Q3, which accelerated from Q2. Services spending, 3.7%. Still the backbone of consumption. Goods spending, 3.1% increase. Gross private domestic investment down 0.03%. Residential investment, 5.1% down. Exports, plus 8.8%, while imports were negative 4.7%. Net exports in a big way. Government consumption, plus 2.2%. All contributions contribute to a 4.3% GDP boost. Now, this makes me think the Fed may be sandbagging the next 3 years, and we may get an everything rally in 2026. I don't want to be too bullish. We could definitely see some retracements, and I would be shocked if we don't go through next year without at least a 5 or 10% retracement. There is nothing on the horizon other than unemployment continuing to go up that could take us 20% down, in my opinion. And I think 2026, we're going to see the broad market rally along with technology. And I'm excited.
He's excited. I'm a bit surprised actually. I don't know if this is actually um good for cuts. I mean, if the GDP is doing so well, then this might give pause to good old Jerome until we have a turnover in May. So this might be a headwind for that particular item. So while the market's rallying, I'm kind of curious as to why. I mean, it's positive and negative, right? The economy's in good shape, but in terms of future, it might be tough.
So I have some thoughts on this. Do we
Your thoughts?
really need a rate cut before May? Think about it. We get a new Fed chair in May. We can still get 3 rate cuts next year. You could go June, July, September. You could go July, September, November. I mean, we could still get 3 cuts next year. They don't have to cut the first couple of meetings.
No, I mean they don't definitely don't have to. They'll wait until I get in, and you
Oh,
know,
I forgot. It may not be Hassett that gets in. It may be Real Mad Money, who can neither confirm or deny. He is being looked
2026
at
Fed chairman candidate.
as the next Fed chair. Cannot confirm or deny.
I can't confirm or deny.
But what we can confirm is that he is the White House's favorite quant, and he is here with us right now, live
It's the best.
for the community.
I'm yeah, I don't know how to digest that appropriately. I mean, 4.6 you said? That's insane.
4.3.
4.3. Either way, that's insane.
It's incredible. I thought we were supposed to be in a recession, sir. I thought I was
I never think
told
that.
I was told we were supposed to be in a recession, that the economy was going to slow, all these tariffs were going to be bad, food prices were going to be up, inflation was going to be up. I mean, this is what I was told. That's exact opposite. Up and down the line, the exact opposite.
I mean, never thought about recession per se, but I definitely thought things were slowing more to a halt. So, but the thing is to note, and I'm curious about this piece is I don't remember the sequence of events. So I mean, I know some of these imports obviously are down because of tariffs. That makes a complete sense. But I'm curious if there's been any deals between now and the beginning of Q3 that would have transpired that would, I don't want to say kickstart, but then if you think about going into Q4, if those imports year over year stay flat rather than be down, what was it, 3 to 4% or something like that, then you could actually have a phenomenal Q4 print as well, from a GDP growth perspective.
Uh-huh.
And so I'm kind of curious, thinking about it, like how some of these deals have been, because I know China imports are down because obviously the excessive tariff percentage that we're charging them, and now that that's kind of been lightened a little bit, yeah, I'm kind of curious going into the end of the year how some of those things have maybe been fully offset with issues that were kind of starting in April to now, and deals being made.
I think Q4 is going to be really freaking strong, especially with the way all the companies guided for Q4.
Mm.
I'm really excited. Now, we have some companies that are rallying right now. NVIDIA, 188. 188. I'm excited. SPY's up a little bit, 687. Then you got some companies that are selling off. Do you know what's selling off, sir?
What's selling off?
Nebius.
Really? Good old
Yep.
Steven. Is timing once And for all working for Steven?
And I said that I wanted to wait till today because I wanted to see if the rally got faded, and it's getting faded. It's down 3%.
3 whole percent, Steve.
3%. Not that that makes a big difference or anything.
Are you piling in all at full port?
Full port? No. That is not happening. But I do want to give myself a Christmas present. So you know what we're going to do? We're going to do it live. I'm going to give myself a Christmas present right now. Why do I have Teams notifications?
Because Steve, you have it installed on your phone. I don't know what
Don't
to tell you.
people see that I put out of office on both my freaking email and my calendar?
I mean, when you're the chairman of wherever you work, Steve. I mean, I know I shouldn't say that because you probably have coworkers.
Freaking autocorrect. I went to message, okay, I'll set it up, and I must not have hit the right thing, and the first word came out as kill. That would not have been good if I sent that to our CFO.
He'll set it up. But yeah, no, I mean,
So right
Steve's
now
high
we're
flyer.
logging in. We're logging into the good old account, and we're going to do it live for everybody. We're going to start a position in Nebius. And I am
Steve,
officially getting on the train with everybody.
Did you lie to me yesterday?
I don't lie, so no.
You said you weren't into Marvel, but I never asked about Star Wars. Obviously, you might be more into Star Wars than you are into Marvel because
Yeah,
Yeah,
Star
good
Wars
old-
is amazing.
okay.
I mean, it's not that I'm not into Marvel.
You said you hated it, Steve. You said it was your least
What?
favorite thing of all time.
I don't watch any of that stuff. Like The Punisher was great. You know what movies I really like out of it, and it's not even Marvel? The X-Men movies. But those are Fox.
They're Fox now.
They're Fox.
But you know who owns Fox now, Steve?
Who?
Disney.
Do they?
Mhm.
Oh, interesting. I actually
Okay.
really like the X-Men series.
I thought they bought Fox Broadcasting.
I don't know if they did or they didn't. All right, we're just waiting for the security code.
Sorry, 21st Century Fox. Yeah.
I'm wondering why. Here we go. All right, we're in. We're in. NBIS is the position.
Yeah, so
Good.
Disney now owns all X-Men and all related characters because of the 20th Century Fox deal in 2019. So it brings all the Fantastic Four, X-Men under the Marvel Studios. Which, to be fair, they've done a pretty shit job of integrating.
I am officially a shareholder of Nebius with everybody in the community.
Would you buy one share?
No, I started a position, not one share. Would I do that to you?
I don't know, Steve. Sometimes you drag your feet, just like you're dragging your feet on VG, and you lost out on like whatever it is.
Where's VG at? 692.
That's what I'm saying, Steve.
Whoa.
Snooze, you lose.
Snooze, you lose.
We were talking about it with our boy who bought, a good amount of shares, and he bought a whole $1 ago.
Okay. Snooze, you lose. You're right. Snooze, you lose. We are going to wait and see what happens tomorrow with VJ.
Oh, there it is. Yep, he's not buying it.
But I'm going over to a different account. We're going to make a little purchase. You ready for what else I'm purchasing? Something that Matt Money is not going to be happy about. We're going to buy a little BMNR, a little bit more.
I don't hate that.
You don't hate that.
No, it's just I don't hate BMNR. I'm not buying it until it goes to zero.
Wow.
And by zero, I'm being facetious. I'm buying it when it's in crypto winter.
So live on the stream, we bought some Nebius and we bought some more BMNR. I think that's all I'm doing today for my Christmas gifts to myself.
Ooh,
Maybe
BMNR back in the 30s.
I got it at 29 something.
I like it.
Yeah.
Congrats anyone picking up here. I think it'll be, but Yeah, it'd be nice to pick up good old BM&R when it's struggling a good bit next year.
I mean, that's what we want to hear out of the shop.
But at the same time, I could be pulling what you did with Nebius, dragging my feet forever. And next thing you know, Ethereum goes to the moon, and everyone's going to be like, "Why? What do you
I
mean thoughts
mean,
on Next? How many videos do I need to do on VG and Next, people? I mean, come on."
you heard it here first from the shop. Okay. Oh, Matt, by the way, I found something that is truly amazing. I'm going to go off topic for about 30 seconds. Did you know that Reese's made a peanut butter filled pretzel?
No, I didn't.
Bite
But
size?
no, I did not. But what was I gonna say? That I forgot to message you yesterday. That picture of that somebody made, I think was it Ray? Who made it? I forget who it was. Of
Spencer?
No, not the one before before Spencer sent. That you showed at the beginning of the stream yesterday when Chris was still not on yet.
I don't even remember what picture.
The one that is whatever the painting of the Sistine Chapel, whatever that
Oh,
is.
yeah.
Whoever made that is a goddamn wizard.
Legends.
It needs to. I need to save that and send that around.
Legends. We're going to show it again. I'm going to find it right now. Legend.
I was crying when I saw that yesterday, so I'm glad that you brought it up on stream.
Now, I know I replied to it. That's how I'm going to find it. Like, whoever made this, please, for the
Keep it
love
going.
of God, continue to make more. We need.
I'll pay you. I'll pay you to make them.
We need more memes of this with the White House's favorite quant, the Shep, flying and floating with the angels. We need it.
In the arms of the angels, fly away from here. That's just insane.
I mean, this is amazing. Would it be weird? Do I have your permission to like send this to a printing company and get this made and frame it somewhere?
If I would hang that behind me.
If you hang this behind you, that would be so heroic.
I would hang it behind me for sure.
I think you should. I think you should go to a printing company, print this out, get this framed, and put it up in your backgrounds for all your streams.
I think I need to get this on a t-shirt is what I need.
A t-shirt doesn't do it justice. This is a Mona Lisa. This deserves.
I would get it in a gold frame. A gold frame.
Yes. No, wait, hold on. A wooden frame. Like a really elegant wooden frame with all the ridges in it. I think you got to do it, Matt.
I think I need to put it. I need to paint. I need to pay someone to put this on my ceiling in my bedroom.
Now that would be heroic.
That's heroic, but kind of a lot.
I don't know if that's a lot or not. That would be
That's ridiculous. A lot, dude. That's a lot. I don't know. Just looking up and seeing myself replicating the Sistine Chapel in my own bedroom, like that is too much. That's pushing it too far. Like, I'm having fun with it, but that's just too much.
What if I pay for it?
I don't know if I could ever have a woman over again. She'd be like looking up. She'd be like, "Is that you?"
I mean, in all seriousness, find a painter. Tell me how much it is. Let's do this.
The real question is, and I don't know if this is disrespectful, so I'm not trying to be disrespectful by saying this. I need to close this blind. Is putting DJT's face on top of God's, is that too much? That might be too much.
That's a little. That
might be disrespectful.
It's a little much.
Oh, so people are saying the Matisse.
Anyway. Little nuts. Chris Patel's in the chat.
Hey, get him on here.
Chris, I just noticed you're in the chat. If you are available, go to your WhatsApp.
That doesn't really help.
Huh.
How can I hide?
Ori, thank you very much. Why doesn't Palantir rally with the market? Because, in my opinion, it is grossly overvalued. And if they don't absolutely shatter numbers in Q4, could get ugly. Rusty, thank you very much. LNG is cooking today. Degenerate Boyle holders for the win.
There you go.
There we go. There we go.
LNG is cooking, or Henry Hub is cooking?
Somebody's cooking. Now, Matt, I have not watched CNBC today because I had a delivery this morning. We tore apart. Can I just tell you, we put, of course, genius idea, right? Turns out to be a horrible idea. We had put a couch in my office that had a pull-out to sleep on just in case we needed one. Thing was so uncomfortable. I can't believe how heavy this freaking thing was. We had to take this apart to move it out of my office. We just got new sofa and chairs in the living room. So I moved the other couch in here. And I got to tell you, I like that Baby Yoda's behind me. I really like
He's watching over you.
He's watching over us.
Making sure that he's making sure that the force is with the stream.
He's making sure that the force is with the market. Now,
I like that. The force is with the market.
Force is with the market, all right? Baby Yoda making sure that the force is with the market. Now, there are a couple of videos that I picked out that I want to listen to with you.
Okay.
We're going to start with the little dividend thing. Jenny Harrington, top dividend plays for 2026. Are you ready?
Hold on. The philosophical investor just messaged underneath, and obviously, I think he was the individual that made it. The artistry that you just shared
in the chat,
and he said it's a pleasure to send you guys more. So please, philosophical investor, please, that would be anything that you do. If it's that quality, I would love to see what you do with Steve.
Let's not
the milkman.
Listen, I don't know, philosophical investor. I don't know how you're going to top what you put out. Okay, but if you can top that, I'm going to be seriously impressed.
Can you imagine? Anyway, sorry, I'm looking forward to these videos, Steve.
Yeah, because I have not watched.
I don't know how to get rid of this. It's a sunroom, people, and we don't really. I need to figure out how to block that out.
I mean, I'm surprised you don't have a punching bag hanging from that beam right there.
I mean,
my dad's probably going to see this and be like, "Where's the punching bag?"
Do you think that would help the Airbnb rental?
I do not. No.
We are putting in a putting green in the spring.
Are you really?
Yeah.
Oh, I like that. That'll help. That will help.
And a ping pong table, and
that will help.
We're right outside here. There's a nice little seating area, so we're gonna get some nice. I was telling you on the phone earlier. So we're gonna update the outdoor seating area. Oh my god, a black squirrel.
Mad money. All right. Are you ready, Shep?
I'm ready.
All right.
Dividend plays for the new year. Okay, you have 4 for our viewers. Let's go through them.
Okay, I tried to do it like a Christmas present. So I'm giving you a wide variety, a REIT, a material, an energy, and a healthcare stock. We've got Amcor.
Okay. A REIT, an energy, an industrial, and a healthcare. What do we think they're going to be?
I thought you said materials too.
I already heard what you just said for the first one. It was Amcor. So outside of Amcor, what do we think they're going to be?
Amcor, which one's that? The materials?
I think so.
Okay. So materials is out. A REIT? How's Vici doing? I know somebody got upset the other day when we weren't giving our our shout out to Vici. Vici's down a bit too.
I like VC, but I am not bullish on the casino industry, and they're screwed if the casino industry gets squeezed. I looked at Caesar's numbers; they suck. Just saying.
Yeah, people are saying that they're getting hit pretty bad right now.
So I think we're gonna go. I'm going with Verizon, I'm going with Chevron, and I'm going with Realty Income.
Is this what I'm going with or what she's choosing?
I'm going with that she's going to say. I have not seen this yet.
So you're guessing what she's going to say.
Yeah, that's what I'm saying. Let's guess what she's going to say, then play the video.
Well, she already said.
She said Amcor, so obviously we can't say that.
Damn, man, this company is just.
Oh, yeah, I forgot healthcare. So UNH for healthcare.
She said healthcare.
Yeah, she said healthcare.
I think she's going to choose Novo.
Okay.
Real estate. I'm going to go out on a limb. And I think she's going to choose OHI
Ooh.
for
I
real,
like Omega.
real estate. I know you do.
I've been a shareholder for a long time.
Damn, that yields up to 6.15.
Dude, Omega Healthcare's yield was over 10% at one point.
I know it was down pretty tough.
I know.
It's been on a little bit of a run here.
A little bit of a run. Some would
Let's
say.
see. Normal dividend play. I think she'll go with Pepsi.
Okay.
Let's play it.
All right, let's go.
Core, Bristol Myers, Enbridge, and Vici. Most of them have about a 6% yield, other than Bristol Myers, which is about 4.5%. They're all in that kind of 10 times earnings range. They all have decent earnings growth ahead. Bristol's earnings growth is further out. But in the meantime, Bristol is a huge cash cow. And they all have something, I think, out of the 33 or 34 stocks in our portfolio, the reason I chose these is because they should give you a nice, safe way to have dividend income next year, no matter what the market does. So Amcor, for example, Amcor had a huge merger with Berry, their biggest competitor. And as that integration happens, they've got 13% earnings growth ahead next year, 11% after that. It's a dividend aristocrat, completely unappreciated. Bristol, I think with the way we've been seeing the healthcare conversation go and the drug stock pricing, there's finally some appreciation. Those stocks have all been under a cloud, and it looks like at least there's some clarity coming. So Bristol should be a beneficiary there. Enbridge, a huge pipeline company. They've got about 40,000 miles of oil and gas pipeline in Canada and North America. If we think the data center play continues and there's unfettered demand for energy, you want to be in both oil and gas. I don't want to play the cycle on oil and gas prices. I just want to know that if it's moving, I'm collecting income there. And lastly, Vici. Vici is a pretty cool company. So they own mostly casinos. They have some bowling alleys too, but think of it as casinos. And their tenants are companies like MGM.
Why would you say bowling alleys? They own golf courses.
And Caesars. So they have 100% occupancy. During the pandemic, when almost every REIT out there had some occupancy issue, they maintained 100% occupancy. That should continue into the future. It's on sale right now. It's down almost 10% from its high a few months ago because people are saying ooh, Vegas isn't doing well, international travel. Wow. That doesn't matter. Caesars isn't saying suddenly we're going to stop leasing major casinos from you.
Yeah.
Those are super long-term. It's a triple net lease.
I got a question for you.
Yeah.
I got a question for you.
Bring it.
Where's the disconnect then? I mean, if they're so heavily, levered to casinos, pull up Wynn. Yeah. Year to date.
Oh, but
Las Vegas Sands.
But those are different businesses. Those are not triple net lease REIT companies.
But I mean, you said as part of your thesis that why the stock hasn't done well. Oh, Vegas.
In the last couple months.
The stock's up 45% year to date.
I think
casino stocks have done great.
Okay, but I'm just saying you can buy it now. It's 10% off its high.
No, I know, but why is it down?
I think it's silly. I think because there's been conversation about weakness in Vegas. Oh, and then there also maybe a little bit of the stock had run up into that because there was the thought that there was going to be a gaming license in New York City that didn't happen. So it backed off after that. But the bottom line is you get something with a 6.4% yield, 100% occupancy, one of the hands down best management teams. And this is our job as active investors.
This chart's just strange to me, the comparison. That's why I ask you the question. If there was a negative feeling on Vegas, Wynn and some of these others. Now, I know Macau's part of it, obviously.
Maybe if we're getting that granular, maybe it's more the New York license.
You mentioned that.
Because don't you hear that? Don't you hear people talking about Vegas volumes are down?
Yes,
I thought it was. You don't? I do. Everywhere I turn, Vegas.
I hear it all the time. I mean, I look at Caesar's numbers and they suck, but let's bring somebody on before we go any further with this.
The hot Chris?
Mr. Chris Patel.
Oh,
Jeez, man. What's up, guys? What are you up to?
look at that fresh cut.
Where it's not a fresh cut. I just combed it a little bit. Dude, do y'all ever get tired of just being on stream?
No,
It feels like you guys are your own CNBC. I mean, it's just like the Amit and Friends verse at this point.
We do it for
You
the
know?
people.
we
The
do it
only
for the community,
criticism-
Chris.
The only criticism that I have is that you guys don't consolidate. Like, I feel like every time I see Tanner live, then Tevis is live, and then this guy's live all at the same time. And I'm like, okay, which channel do I go to? And the thing is, like, if you comment on one, the other people can't see. Now, here's the thing, though. I think YouTube has this feature now where you can go co-live together. So you got to figure out how to do that so that this way, like when you have, like, let's say 50 people here, 100 people here, and 200 people here, they're all talking on the same chat section. Otherwise, you kind of get lost in the sauce, and then it ends up being like someone's asking a question or someone's saying something, and if one person doesn't address it, then it gets completely lost. You know what I mean? Like,
I think you're a hater, Chris. Just kidding.
I'm not a hater. I'm on the stream with you guys. If I was a hater, I wouldn't exactly be on here supporting y'all.
I'm just messing
You know.
with you, brother.
No, I'm just saying from a technical aspect, it's like, you know what I mean? You kind of want to.
So I think I have an answer for you. If you look at the chat in StreamYard, it shows everybody's, I believe. But if you look at it on YouTube, it's just the singular channel.
Yeah.
Is it?
exactly.
Yeah.
Yeah.
So if I post a comment on StreamYard, it'll post to everybody's channel. But if I post it on my YouTube,
Yeah.
it'll only be on my YouTube.
Yeah. It's a
Ah,
problem.
okay.
So that's why I try to respond in the StreamYard one.
Interesting. Like I said, I know that YouTube now allows you to do co-streaming, so it might be a
I've
good
looked
idea
for
for
it.
us.
I haven't found it, and I've seen what you're talking about, Chris. Especially like people that collaborate on videos.
Yes.
I've seen that where it's like you have two like powerhouses that come together to do like a podcast.
Yep.
And so I've seen that, but yeah, I haven't seen like a single live where it says Matt and Steve are going live at the same time.
Yeah,
or something like that.
Not
I
to
haven't
mention
seen that.
also from an alerting standpoint, it makes a lot of sense, right? So like if Steve is going on live and Matt, you're joining, you kind of want to have both of them get alerts at the same time as well, and basically bring the audience together. So
Yeah, no,
How
I
does
don't,
that
know
work?
I don't know how to do that otherwise. And that was part of the reason why I made that 24/7 live stream channel, so that way it at least could get some sort of like schedule out so that people know like when certain people are going live.
you mean the White House stream?
the White House? Yeah, the White House scheduler.
Yeah.
So when
the
so that
real
so that
question-
Tanner can go live when Donald is, so he can give commentary. Just
Hmm.
kidding.
Yeah.
So we're coming off of a crazy print on GDP. Crazy print. Are we going to hit 7,000 this year, Chris?
Probably, but I'm more worried. Like my mindset, my focus now is not a couple of points here and there for the rest of the year. Like, do I really care about the next 7 days? My planning now is 2026 and 2027. So I'm trying to see, like, are there any structural weaknesses that we're not thinking of? Are there any chances that inflation reignites for whatever reason? I mean, my thesis is that there are counterbalance points on both sides, that inflation could rise, but then at the same time, there's other things that are telling me that inflation's decelerating. So like shelter's decelerating, which is good because that is going to help inflation. But then core goods is going up because now you've got those inventories that are finally starting to level off, in which case now you got some restocking. So the prices that businesses are going to charge should go up, not a lot, but enough to cover some of their additional overhead. The other thing is the immigration crackdowns are starting to impact, in my opinion, like I said, I've been seeing this, farmers, a lot of the farm workers are Hispanic illegals. And so there's been a lot of reports around crops at the field basically going unpicked, and they're just basically dying on the vine, and so they're having a real tough time finding people to work the fields. So, it's one thing to keep in mind, because eventually it could do one of two things. It could end up hurting both President Trump in 2026 from a political standpoint, because one of the things is, like, if you look at the heartland, it's traditionally been very Republican. So if you kind of lose that segment of the population, that's not good for the presidency, and also for a lot of rural Republicans that could take them out. And the other challenge that you run into is with regards to the pricing on some of this stuff. It means that if some of these farmers have to rely on more mechanization to kind of backfill that labor shortage, we could see a rise in food prices, which once again could theoretically derail the current rally, in which case there could be talk of us going from cuts next year to rate hikes, and that would not be good. Like that would, I think, throw the market for a tizzy. And I think that could actually be a buying opportunity, because then it would be that the market kind of almost like forces a Liberation Day kind of event, where it makes the Trump administration kind of soften its stance on maybe deporting every single illegal, no matter what. And instead just focusing on, the illegals that are more in line with I don't want to say non-productive, that's probably the wrong word, but like just refocus on more like criminal aliens, rather than focusing on, like the home builders and people that work in the agricultural sector, people that are working in, services that, yeah, they may be illegal, but they do provide a counterbalance to wage pressures, which right now is a bigger deal than in the past. So yeah.
Where'd Maddie go?
He probably stepped away for a minute. Like I said, I'm trying. This is not about being political. I think it's just being a realist, in that even if you did want to get more, like natural born American citizens to be in the farming industry and get into, manual labor in the fields, number one, you're going to be hard pressed to find a lot of people willing to go that route. And then at the same time, the wages that they're willing to work for are not going to be the prevailing wages that are currently supported. And, it's more likely that we see consolidation in the farming industry. And I'm not a big fan of that. I don't know if people know this, but my family is like 13 generations of farmers in India. And we still have plantations in India and stuff. And one of the things that you see over time, and it's happening over there, is that over time, as like the economy develops, you see more and more and more consolidation. And the reason why you see that consolidation is the only people that can afford some of the costs associated with the scale up in basically maintaining costs is the people that can buy the most advanced mechanized equipment that's out there, like John Deere. If you see some of the stuff that's coming out from like John Deere, it's crazy. Same thing, I don't know if you guys know Massey Ferguson. Amazing company. They have some crazy like AI tractors with like satellite connectivity. But the challenge that most farmers run into is that these guys have everything vendor locked to the point where no one can repair their own stuff. So it causes this dilemma where you're relying on these really expensive pieces of equipment. And the only reason you can afford it is because you have enough land to be able to make it, to cover the cost of upkeep. A small mom and pop farmer, someone that's more like, I don't know how many acres would be considered small, but someone with a smaller footprint cannot afford to have these crazy level expenses in mechanization that could offset the labor deterioration. So a lot of them end up having to sell, and who ends up buying? It ends up being big conglomerated, organizations that have huge resources. And like I said, and then they end up utilizing their scale to do what? To raise prices, because they can do wholesaling. And this happens in India too, where if you get a concentration of one particular group of people whose profit motive is very driven, if they get enough scale, then they can theoretically crowd out the market and say, hey, listen, we're gonna provide tomatoes at this fixed price. If you don't want to buy it, that's your problem, not mine. In which case now the end result is that us consumers, we end up paying more. So I don't know how to best phrase it, but
yeah. So Maddie, Rusty gifted 5 Mad Money memberships.
Genuine gentleman right there. I
Thank
much
you,
appreciate
Rusty.
it. Congrats
Thank
on the
you.
win today, brother. He was like I think he was in Boyle, and Nat Gas is up 9% today. Chris, why is Nat Gas up? And the thing that's surprising about this, I want to get your thoughts. VG just about to cross over $7 a share. So we no longer have to answer our margin calls. That, I've been waiting for Donald to call, and next thing you know, I just keep getting margin call. You know, they just keep calling and calling. No, but in all seriousness, curious on your thoughts because TTF and JKM, while it looks like they've had a short-term bottom, for anybody that's listening, TTF is pretty much the Europe title transfer facility, and JKM is the Japanese and Korean marker for LNG. They look like they've had a kind of a short-term bottom, maybe a slight uptick. But then you have Henry Hub growing 9% today, but yet VG is up like a monster. So I'm kind of curious. Do you think it's more sentiment driven? People realizing it's oversold. People are realizing that potentially all these gluts and everything that everyone is talking about are either getting pushed out into the late 20s or early 2030s. And so maybe it's not as much of a concern. Curious on your thoughts about that because people
Yeah,
love
I mean,
about VG and Next.
I think you hit the nail on the head, man. I think there's definitely going to be this picture of a short-term natural gas picture right now that we're dealing with. But I think the longer term, the news that ET was canceling their Lake Charles project, Woodside delaying their commissioning to 2030 plus, like they got the approval for that. You've also got the Japanese and the Koreans kind of like running out of time on how much LNG they can get from Russia, like for their sanctions. Like, so they were able to get sanctions relief this month, but the continuation of those sanction reliefs may not be there. So a lot of utility companies and like Japanese utility companies, let me just show you the thing. They have LNG coming in from Siberia, where they own a equity stake in this one. Let me just bring it up 1 second. And I don't know if you know this, but I think Shell was forced to sell their assets. So have you heard of this thing right here? Sakhalin 2. I think I'm probably butchering the name, but
SAKH.
Yeah, Sakhalin 2. It's a oil and gas field here in Siberia. Yeah. So the thing is, if you look at their long-term cargoes, are, a lot of them go to what is it called, to Japan and Korea. And the challenge is they've been basically getting these contracts, and they've had 20-year contracts. So you can see they're all kind of rolling off right now, like Hiroshima Gas, Korea Gas, Toho Gas, Tokyo Gas, right? And they all signed up for 20, 30-year contracts. And so a lot of them are coming due. And one of the challenges is that the Japanese, like a couple of them, own equity stakes in the project itself. And right now, the U.S. has been kind of gracious enough to allow for sales to continue. So U.S. allows for oil sales from Russia Sakhalin 2 project to continue through June 18th. But the U.S. is kind of pressuring the Japanese to say, hey, listen, guys, we get it that you guys have an equity stake and you want to protect it, but at the same time, like, hey, it's the Russians, like there are enemies, like we're sanctioning them, kind of back us a little bit. And so I think at some point the Japanese are going to have to switch over. And I think that's one of the reasons why, if you've seen a lot of the deals that have been being made with Venture Global, you're seeing that a lot of them are utility scale providers that are buying up stuff, right? So I think the point is, in the future, the Japanese are going to have to secure a strong, reliable energy infrastructure play where they have guaranteed cargoes at reasonable prices. And I think with regards to that, the U.S. could theoretically do it. The only challenge is the Japanese are facing inflation, so they have to make sure that they're actually like getting a really good deal. And Venture Global benefits from that because Venture Global is probably one of the lowest cost producers of LNG in the country, in the world right now, outside of Qatar. Qatar, you can't beat them. Like they get like the unit economics on Qatar is like insane. Like they'll make money if natural gas drops to $1 per MMBTU. That is the level of unit economics and scale that they have. But everyone outside of Qatar, LNG projects are going to have a tough time getting financing if the spread is not at least $4. And VG can make money at $4. No, not a lot of these other guys, a lot of these other projects can hit $4 of spread and make money on it. So that could be a major like tailwind for VG in that it's almost like being the lowest cost producer. Like you set the floor really low. And so you're the only one that can sort of like capture a ton of market share, and no one else can get the financing to get these new projects done. And the thing is, Venture Global can self-finance now because they've got cash flows. So while they do have a tremendous amount of debt, they do have enough cash flows to kind of float their own capex going forward. And so you got this weird situation where they've got like the sword and the shield. And have you ever seen a business model like that? What happens is their fixed tolling that they have is their shield, and that shield is against like bankruptcy and creditor calls and all sorts of issues related around the debt. And their sword is basically their spot cargoes, so that let's say natural gas prices spike, they can go on the attack and basically generate a ton of cash flow and take that cash flow and reinvest it into debt reduction. Very similar to what Cheniere did in 2021 and 2022, but Cheniere didn't have nearly the amount of spot cargo exposure that Venture Global has. Like if we get another Russia war, Ukraine type situation and prices on JKM and TTF start just going haywire, dude, those spot cargoes are going to be worth billions, So I'm not hoping that we go that route, to be honest. It's like you really need the world to go to shit for something like that to happen. But the point is, that strategy of keeping the floor prices as low as possible, I think is going to crowd out a lot of other projects from coming online, at least until probably like 2035 for a lot of them, if they ever come online, in which case now you've got Venture Global that's like a dominant producer. So, that's the whole thesis behind Venture Global, by the way, long term. So
big shout out to Hot Doug. I would say if anybody doesn't follow Doug's takes, man, he's been doing a phenomenal job. Him and Austin, actually, they're on episode 6, probably going to start episode 7 probably tonight or tomorrow, if I remember. So I just put Austin's YouTube in the chat, and then Doug, I'll put his YouTube in the chat. But they do another stream, and these guys are like yin and yang. They do a phenomenal job, not necessarily, being talking heads, agreeing with each other. They do a phenomenal job spitting different pros and cons at each other throughout and going through each individual line detail. And I would like just to state this: Doug and I have become really close over the past year, and he's been a good friend. We try to get lunch at least once a month, if not more. And so it's been good to have somebody local to bounce ideas off of and keep me grounded when my head gets too big about getting on the White House news page. So anyway, just kidding. But just thank you, Doug, and Merry Christmas to you, and hopefully you and the boss lady stay safe during your travels, man. Much appreciated, and looking forward to seeing you when you get back in January.
All right. Well, S&P up a little bit further, 6907, guys. I'm excited that this is going to happen. I think we're going to get it next week. Are either of you buying anything going into the end of the year? Chris, you're on mute.
I'm just letting my NVIDIA do its thing, man. I do plan on possibly, if the market really, really starts to get overheated over the next few weeks, I'm going to be selling into the Santa Claus rally, but I'm not going to be selling my position. I'm going to be selling against it, so that this way I can create a spread, take a lot of that cash, put it onto the side, just in case we do get sort of Liberation Day kind of pullback of about 10-15%, I'll have dry powder to buy back a lot of those short level positions and then just, and basically capitalize. Like I got caught off sides a little bit by Liberation Day in that I really should have plowed way more money into some of my more higher conviction plays rather than TLT a little bit. But but I think I got TLT timing wrong for sure. Yeah.
Matt, are you buying anything into the end of the year?
Nothing abnormal. I would say I'm just going to keep my normal paycheck buys, which are the SPY, Palantir, Rocket Lab, Venture Global, Next Decade, Northern Oil and Gas, Granite Ridge Resources, Dutch Brothers. Is there anything else? Oh, and Amazon, I think, as well. Depending on if Dutch Brothers continues to kind of be super strong, I might turn off the buys on the bros. But we're having a nice breakthrough on VG right now up at 704. Nice.
Yeah. Yeah, we know a few people that bought a lot of VG.
Yeah.
I still haven't got to my 100,000 share goal yet. I'm working on it. It's getting there.
If
I have
you get
a lot
there, man, that's impressive. I don't have nearly that much.
Okay. Just to let you know, I have 100 call options on VG, and I have another 200 in my 401. So now the thing is, like, I bought them as a spread, so it's not like some of it's subsidized, but the thing is, like, this might be one of those things where I just hold it to expiration and just exercise them. So this way, like, if you look at the prices on them, and they're actually relatively cheap, so just in case it runs really hard, I'm not super like oh my god, like I missed out. I think sometimes it's just one of those things. Like I wish I had more capital right now to buy VG, but I don't. Like, unless I sell some calls against my naked Nvidia, which has slowly ballooned into like one of my larger positions right now.
But that's a smart thing. I mean, I don't think I've ever really thought about that. Like, if I'm super short on cash, for example, I plan on doing this with some of my Rocket Labs. I bought some $5, $7, and like $12 Rocket Lab calls, like when earlier in 2025, when it took a big dip into like the 17s or 18s or something. And everyone thought Rocket Lab was going to go back down to like $6. I bought a lot of calls, and those are up, a couple 100%, probably more. Actually, I need to check how much they are, but I plan on just converting those to shares, because why? Although that's a good question, I've never done that before, so I'm curious, if you convert to shares, does that mean you end up paying the capital gains on it or no? That's a good question, but anyway.
I don't think I've never exercised the option. I've never in my entire life exercised a single option. I've always just sold the option. I don't
know. I mean, I'm the same. I've never converted, but these are ones, like, if you think about it, I got them for a super decently cheap cost basis. So why would I want to
wait? Do you have calls on Rocket Lab?
Yeah, long calls. And,
ooh, geez.
And at the 5.7, I'll read how many. Well, not how many, but which ones I have. But I think they are. Let's see. Yeah, Jan 2027, 10, 5, and 7.
Ooh, geez, man, those must be up nice.
They are up really nice. And so that's the thing. Is like, given that opportunity, if I could just spend a couple $1,000s to buy those, it's more worthwhile to do that than pay the capital gains on, what it is. If that's possible, I'm not exactly sure. I'll actually look it up in the background while everybody, you and Chris, or you and Steve,
we all know who's got the private jet now. It's Maddie.
Nah, far from.
Work on it, Matt. Get on it. But yeah, so I don't know. 2026 will be interesting. I think the AI theme is going to continue. I don't see any relenting on that as of right now. The only thing that I've been keeping a track of, and maybe you guys have some commentary on this, is possibly around software getting a bid finally. Like, there are some names that I'm kind of shocked at how much they've underperformed. But then once I look at the annualized growth rate, it totally makes sense. So, you know, with AI, I wonder if there's an opportunity for any of them to re-accelerate very similar to Palantir. And I am thinking about creating here's the part that sucks about trying to hedge against this current AI wave. There's not a lot of opportunity to short outside of just hoping that the valuation collapses on something like Palantir, where it's like, oh, the AI trade is dead. Palantir's growth rate slows down from 100% to like 30, in which case the multiple is going to compress like crazy and the stock will drop by like 50, 60%. The only thing is getting the timing right is almost impossible with this. So I don't even know how to approach it. So, and even the cost to short is super expensive, because you look at the puts. I was looking and I was like, man, there's not enough juice on this thing to use it as a proper hedge against a market downturn, unless like you really go hard in like the amount of capital that you want to commit towards it. But you know, I like I said, that's not I have to figure out a way to short the AI trade, not because I don't believe that AI is going to do well, but just as a hedge because I've done so well. You know what I mean? Like I just want to sleep better at night.
Mm-hmm. Yeah, everybody needs to think about that. You know, if you move into a different direction in terms of size of your portfolio, I think it's prudent for everybody to take a look and at least think about it. Like I've thought about it as well. Like I've done extremely well over the past couple of years, and I've thought, you know, am I still willing to play that game of Monopoly where I put some of my portfolio at risk, or do I want to move it over into something a little bit more safe, diversify a little bit, and you know, not be as risk, because like as we just saw, like Rocket Lab, for example, it's my largest position. It went from $74 down to $38. Like that obviously showed up as hundreds of thousands of dollars worth of losses. You know, within a
Paper
couple
loss.
weeks time,
Paper losses.
paper losses, yeah, in a short amount of time. And you know, I'm okay. Like I knew for a fact that I'm in it for the long term, and I believe in the company, and it's in its infancy. So you know, yes, is it overvalued here? Yeah, but I think that there's going to be a lot of things. Anyway, I don't need to get too much into that. Um, but to finish the conversation earlier about converting calls to shares, I looked it up on Grok and somebody messaged me. I don't know if they want to be publicly known or not, but if they do, they can make themselves known in the chat. But you don't have to pay any capital gains if you convert to shares. You just have to pay the actual price as if you're buying those shares outright, right? You've
Right.
given yourself the opportunity to buy them at 5, 7, or in my case, $10, and you just pay that. And the only problem is then though is that the timer restarts for whether or not it's short term or long term. So if you've held these options for say over a year and you sell them, you pay long-term capital gains. But if you convert them to shares again, it's like buying them all over again. And so you have to consider that. So if you do any sales or anything like that, it'll be considered short term unless it's been held for longer than a year. So that's something that's interesting. But I think this is actually something that people should consider. And I never really thought about this because I've never really been in a situation where I've held something for long enough and actually want to hold the stock, like Celsius and some of those other plays. Those have always been like swing trades. This has actually only been the time, and unfortunately, I've always needed to sell some of these long dated calls. Like I've had Palantir calls in the past that I sold too early because I needed to fund other things, and this is the only time where I haven't had to sell something so long or so early that that I actually still wanted to keep. And so this could be a strategy for people if you think about it. Most people think you just have to sell to get that money. You don't always have to. You can convert it, and if that's the case, then you know you could avoid paying that capital gains tax if that's something that you are into. But then again, you have to have the cash to be able to buy it as well. The whole value.
Here's the other thing. Does your premium end up going in like reducing your cost basis? Because I mean, if you paid like
increasing the cost basis, right?
Increase or decrease the cost basis?
Increase, because if you buy a call, let's say you buy the call $5 call for $1.84, then when you buy it, you're paying $5 to get that, and so technically your cost basis would be $6.84.
Oh, right. Yeah, you're right. I'm thinking that. Yeah, you're correct.
If you're thinking about puts, then yes, you're right. The
Yeah.
opposite. Yeah.
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 Yes, sir. Yeah. What do you guys think? What's your outlook for next year?
S&P 8,000, everything rally. It is going to be a perfect setup for everything to do well. You have inflation, which is killed. Rates are going to come down further. You have a housing market that's going to get unlocked. You have big GDP growth. You have the Fed economic projections indicating 3 consecutive years of GDP growth, with inflation going significantly lower. We have new Fed chair coming in. So even if we don't get rate cuts in the first half of the year or first 40% of the year, we could still get 3 rate cuts by the end of 26. And this is a scenario where we have a lot of visibility into where CapEx is being spent up and down the line, and where the big companies are allocating capital for contracts for AI and cloud. So I really firmly believe we're going to see old school companies like Coca-Cola, J&J be the ones that really benefit from productivity because they have the balance sheets and the cash flows to actually implement everything much quicker than small and mid caps. And not only will that make their earnings expand, but we'll see increased revenues from the big companies and their EPS should expand. So this is really, I know a lot of people want to get bearish. A lot of people want to say we just had 3 consecutive years of double-digit gains. It's time for a pullback. At some point, we're going to get a pullback. At some point, we're going to have a down year. I don't think 26 is that year. I think we'll have retracements, maybe 5-10% here or there. I don't think we go into a bear market next year. And I'm really not scared of midterms either, because I think the most likely scenario is we get gridlock in Washington, which would be excellent for the market. And I think there's a lot of plays that are going to be really interesting. So we'll see what happens.
I honestly think that if the current build out in AI does not pan out to be what everyone's expecting it, which I'm pretty sure it's not. Like the amount of ROI is going to be like way out into the distance. It's as long as I am on AI in the short to medium term, just based on sentiment, I think this is very reminiscent of the tech bubble. The only difference really with the tech bubble and the technology here is that this one vastly is going to improve everything, very similar to the tech bubble, but the value capture.
Tech bubble, which tech bubble?
2000.
This is nothing like it.
No. There's definitely like similarities to it, but it's
no similarities. None.
Steve, all right. So let me give you the similarities and let me give you the differences. All right, and then we can figure this out. So the similarities are the amount of spend that's happening with no guarantee in ROI is something that people are going to have to, like, we'll look back 5 years from now and ask ourselves, like, wait a second, like, what the hell? Like, were we really spending $1 trillion on trying to develop models that were basically out competing each other and becoming commoditized overnight? Like, that is the question that everyone's going to ask 5 years from now. Very similar to the fiber build out that we had with during the tech boom, where everyone was like, oh yeah, I'm going to buy every single Cisco router on the planet. Like, no, everyone's expectations were way too high. It's not that Cisco was not good and the technology was not good. Everyone knows that AI is the future. I think the AI is the future, but it's that value capture mechanism that people are going to wake up to and say, wait a second, like, did we overbuild? And overbuilding is a natural part of the economic cycle. It happened to the railroads. It's going to happen to a bunch of other things, right? Oil, same thing. Like we had the shale revolution in the 2010s, and Matt knows it. I mean, he was a younger guy, but dude, the amount of money, capital that flowed into the industry at the time was immense. But what happened? You ended up getting a whole bunch of consolidation. The best companies that were able to utilize the technology survived and they thrived. And the companies that couldn't hack it, they went out of business. So in my opinion, it's very similar to that, where right now we're spending a whole lot of money, which is fine. This is just how the technology operates, and eventually people wake up and say, wait a second, the ROI timeline on some of these things are not 2 years from now, they're actually 5 years from now. And at the same time, you have recapital, and a lot of these companies they're going to get recapitalized. What I mean by that is basically, if you have like 100 billion in debt and all of a sudden the debt is not great, the company itself can get valued down significantly to the level of debt, and now the equity position actually becomes valuable, because now all that future earnings that you're going to have is going to go towards debt pay down, in which case now you're actually going to get a healthy return. So my thing right now is, I think we're at the point with AI where, one, a lot of the hyperscalers that have been spending money, they've been spending money from free cash flow. They've converted to starting to issue debt to pay it down. So that's not pay it down, to pay for a lot of the CapEx. There is no other source of money that's going to be coming in after that can support the current build out. So naturally, I think the growth rate in the AI build out is going to deteriorate. I just can't tell when it's going to happen. And if that's the case, then you kind of want to make sure that you're at least somewhat hedged. So you want to have that optimistic opinion that, hey, I think everything is going to be great and we're all going to be in nirvana 5 years from now. But at some point, the market's going to say to you, like, hey, listen, let's kind of take a step back. And the thing is, like with AI, dude, you can almost feel the sentiment turning when there's even a remote amount of bearishness. Like if you look at NVIDIA has not gone anywhere since August, even though their revenues have gone up and their guidance have gone up. What does that tell you? That tells you people are skittish.
All right.
People are skittish.
So,
what time frame is this, Chris? Because
that's the
here you
problem.
are.
I don't know.
You don't know. Okay. Yeah. Because people are in the chat are saying, well, sell all your NVIDIA. And I'm with you. I think that there is some sort of piece at what point, and I'm not saying to do that, right? I'm just saying I'm with you. I think that there will be some sort of slowdown at some point when you can't keep up with the speed of what we're seeing right now, because you've run out of the free cash flow. You're starting to have to dip into the debt markets to be able to fund some of these things while you're maintaining buybacks, while you're maintaining dividends for some of these companies, which is in the order of 10 to 15, $20 billion a year in some cases. Because even though it's less than 1%, you're talking about $1 trillion companies. And so that's tens of billions of dollars for Facebook or Meta and some of these others. And so you're then beholden to the speed at which the ops cash grows from these companies to be able to increase CapEx, unless you want to go into, say, 10 to 15% debt comparatively to your market cap, which isn't that horrible. Then you kind of get into the game that Oracle's playing, right? And is that the right thing to do? Or are you right? Are these things going to actually become commodities where you can't really monetize them other than maybe putting ads on them, like what ChatGPT is trying to do, what potentially I'm assuming Gemini will do from Alphabet. So I don't know. I don't have the answer for you, and I don't want to say why I've stayed out of the trade as a whole, but I do see that as a potential headwind. But I'm looking at it from I still think there's opportunity for growth. I don't think that we'll hit some sort of wall yet, but I think Oracle is a poster child for what could happen if you have poor management. Not saying that Larry Ellison's bad at what he's doing and that they won't be able to come out of it. I think they will, but I think everyone assumes right now, just based off of just maybe the uncertainty of what's going on in the market, they assume that that's what's going to happen to a lot of these companies. And so that might be what's causing a little bit of spook and scare when you see something like Oracle kind of performing the way it has and loading up their balance sheet the way they have. I don't think it's going to get that bad. I mean, I fully believe that you'll have the Googles of the world and Amazons and Metas of the world pull their foot off the gas at some point. But I don't know when that will lead to some sort of pullback. If it's at the latter half of 26, early 27, or maybe in the middle of 27. But I don't think we go into 2028 without some sort of spook that is very much CapEx related, while people try to digest how these data centers and things will get funded. But they need to be funded, and it's kind of like you stated. It's like the internet. It's like all these other things that have happened in the past, you need to fund innovation to be able to make sure that you live past. And sometimes it's not, and I think that this is a piece that I think people need to understand. Sometimes it's not about winning the quarter, it's about winning the war. And a lot of the things that you need to recognize is what companies are setting themselves up to not only be successful in the short term in terms of continuing to innovate and find new things to grow capital, but will also outlast their competition. Because you'll have companies that do extremely well and then they just focus on feeding money back to shareholders. They can stop innovating and they, become worthless. Look at Blockbuster, right? Blockbuster had the opportunity and, they just like, you know what, shareholders, we got the business model already, and so they stopped innovating, and next thing you know, they get destroyed by Netflix. And so it's the same sort of thing. You need to innovate. You need to continue to put the ball and keep the ball in the air, but you need to make sure that you don't go bankrupt doing it. And those are the companies that I think will continue to be successful in the long term. So it's about finding those companies and not finding the ones that are specifically focused on shareholder returns at all costs, because I think that while it might be a useful strategy for 5 years, maybe up to 10 years, I think the companies that strictly focus on that without innovating and changing consumer and feeding into what consumers want, I think will surely perish in the long term.
Yeah.
So there's no similarities to the dot-com bubble. So there's a lot to respond to. One, the dot-com bubble was caused by several things. The biggest thing was that venture companies had to deploy capital and they went all in on an unproven model where companies that were pre-revenue and pre-earnings sold them a bill of goods about being able to monetize eyeballs from people going to the websites, which did not pan out, coupled with the Fed raising rates. That's the big thing. Now, obviously, Cisco, backbone of the internet, continued to spend, and they finally have gone back to where they were. A lot of companies failed, but it was all pre-revenue. This is not that at all. And there's only one company funding this from debt, and that's Oracle. And the reason Oracle is funding this from debt is because hold on. No.
Okay. I'll let you
Hold
finish.
on.
Go. Yeah.
Hold on. The reason that they're funding this from debt is because they're seeing their on-prem software and licensing, which is their legacy business, decline in revenue, and their cloud infrastructure as a service and software as a service expand dramatically. In Q2, which is their most recent quarter, cloud infrastructure and cloud software expanded revenue by 50% year over year. 7.98 billion. On software, they declined by 3% year over year. Now, when you look at how they're being funded versus the big data centers from Microsoft, Amazon, and Alphabet, they're not tapping the debt markets. They are paying down debt. They have enough cash on hand, not even tapping long-term investments, enough cash on hand to write a singular check to eliminate all the debt on their balance sheet. So this is nothing like it. And the big difference is, I don't care about the neoclouds funding it from debt. The neoclouds could go away. Nobody gives a shit. The reality is that AI is being implemented into the cloud services. And this is where the CEOs of the largest companies that are driving the market forward are telling us, this is where we're going. This is how we're deploying it. And this is how it's going to be utilized in every piece of software, from cloud infrastructure to products like Microsoft Dynamics. Now, as far as visibility into revenue, we're seeing increases across the board from Micron, Broadcom, and NVIDIA. But what's more important is the remaining performance obligations from the big four. And I'm going to throw Oracle in there, even though I'm not 100% sure how much is going to get recognized because it's such a large number. And a lot of it's from OpenAI. Oracle reported over 500 billion in RPO. Microsoft 392 billion. Amazon 200 billion. And Alphabet 160 billion. That is night and day different because there was no RPO back in the dot-com bubble. And these companies are not going away. And they're the ones that are spending on the data centers because of the locked up demand that they need. So I have a very hard time believing that this is anywhere close to .com. And we may be still in the infancy, which people don't want to hear, because we haven't even seen robotics and FSD come online. And I am not a big fan of FSD at the moment, but we have to at least realize that the amount of compute that's going to be needed over the next 10 years as these industries come online is going to be vastly greater than where we are today.
Yeah.
So,
Yeah, go ahead.
I good question for that. I mean, you're saying I want to give you an opportunity to backtrack a little bit. You're saying that there's zero correlation to what's going on now with the .com bubble? Zero.
There's
I mean,
no correlation.
I know it's apples and oranges, but you think that there's no similarities.
No.
So
This
you're
is
thinking
not-
that all this venture capital money that's going into OpenAI and all these other companies that are being able to be valued at hundreds of billions of dollars without even
Trillions.
making a single,
Trillions.
sometimes trillions of dollars
Correct.
without even making profit. You think that's not at all similar to what's going on in the .com bubble? I'm not saying it's maybe to the
Here's
extent of it, but
why-
I'm thinking there is some similarities here, Steve.
I get what you're saying with OpenAI, and I take OpenAI out of it because I can't see what their numbers are, so I can't comment on their numbers. Now,
What about Anthropic?
they're a private company. We can't see their numbers.
Oh, but that's what I'm trying to tell you, that there's so many of these companies that are saying,
The
like, listen,
reality is that if they leave and if they go under, who cares? Who cares? It's
the
about
market
I-
cares.
it's
That's
about
as dumb
Alphabet.
as- yeah.
It's different but similar. I mean,
it
look at
is
all these
about Alphabet,
look at all these
it is about
SMR
Microsoft,
companies.
and it is about Meta, and it is
Hold
about Amazon.
Steven, hold on. Go ahead, Matt. Perfect reply. Go ahead.
What about all these SMR companies, robotic companies, AI companies that literally are going to go to zero in the next 24 to 36 months?
Oh, I
And
hope that's
people are
the
bidding
market.
them up and adding capital, and that's not at all reminiscent of what happened in the. I'm not
You
saying
got-
it's verbatim, but it's apples and oranges, but there is similarities.
You got all these industrials that are running super hot right now, like Vertiv, GE Vernova, all of these guys, they're all running on, oh yeah, we'll provide the next generation of data center build outs for this. You got Sterling Infrastructure, which by the way is like one of those positions that I was stupid. I didn't get into. They pivoted from construction to data center construction. If you look at their stock, it has gone insane. Like, there are so many companies that are riding high. Oklo, even you can admit, wait a second, how the hell is Oklo valued at 20 billion plus? Well, the reason why is because they're the data center energy play. You know, this is the problem that I think we have to
Those
acknowledge.
companies can go under, and it won't matter for the market, though.
What are you talking
Oklo-
about? There are
Oklo can go under tomorrow. SMR can go under tomorrow. They're not part of the S&P. They're not part of the NASDAQ. Nobody will miss them. It does not matter.
But Steven, the amount of bleeding that will come is going to come from all the peripheries, and then it's going to work its way up. That's just how it works, man.
So I'm going to give you some stats. Just give me 1 sec. So from Gemini, because this is the model that we actually have stats from, they processed over 1.3 quadrillion monthly tokens, 20x growth in the year. They're processing 7 billion tokens per minute, and they have 650 million monthly active users. Google AI demand, 155 billion backlog, and they're still supply constrained through 2026. Now, those are the only numbers that we have. We do not have numbers from OpenAI. We do not have numbers from Anthropic.
But
I got to believe that OpenAI has got to be somewhere near that realm, even though we don't know. That's why I'm using Alphabet. The
But
reality is that this is where the most important companies are allocating resources. This is where companies are spending money. And this is where the best CEOs in the world are saying, we're going all in on this. And we are embedding this into our cloud services. And every corporation is upgrading their infrastructure to this. Now, is there going to be hotspots? Are there going to be companies that go under? And are there going to be companies that are overvalued? Absolutely. but this is nothing like the dot-com bubble. Nothing.
But Steven, this is okay. Let's dissect this a little bit. Okay, first, this argument around RPO. RPO is one of those things that I think gets thrown around. Oh, look, there's so much value ahead of time. Like we're contracting. Do you know what the RPO on the oil industry is? Oil is going to be necessary for another 100 years. That doesn't mean that you should go out there and buy like, oh yeah, you know what? I need to buy every piece of oil property that I can because there's RPO for the next 100 years.
All right,
Okay.
but hold on a sec.
Yeah.
The oil companies are not expanding cash from operations the way that the big four are, and they never have.
What are you talking about? When oil
Do
prices
I need to build the model?
No, but I'm
Of course.
saying when oil prices jump, then yeah, everything jumps up. The RPO, you don't even know what the profitability on their future revenue is. You're saying RPO, but what does that mean when you try to weigh it against the cost of capital that they have to provide? I could say, look, I have orders right now for the next
capital. They're paying this from profitability.
right, but that
These-
means that that's money that's not going into value creation. That ends up going
No,
into the
no, Chris, that's where you're wrong. It's absolutely value creation. It's just not going back to shareholders from buybacks and dividends. But when we look at the CapEx being spent, cash from operations from Microsoft is up 77% over the past 4 years. Cash from operations from Alphabet is up 65% over the past 4 years. Cash from operations from Meta is up 86% over the past 4 years. Cash from operations from Amazon is up 182% over the past 4 years. There is
Right.
a clear correlation to what they are allocating to CapEx to their revenue and cash from operations expansion. And the clear case that we can see of the company that missed all this was Apple, who has not increased their CapEx. Their cash from operations over the past 4 years is only up 7%. Now, the oil companies, I'm looking at Exxon right now. In 2021, their cash from operations was 48 billion. In the TTM, it's 51 billion. Barely a move.
Right, but this is what I'm trying to tell you. At the end of the day, you also have to look at the free cash flow number as well. If you're spending all of your ops cash on CapEx and that CapEx doesn't end up resulting in any additional future revenues, then you got a problem. So if you look at the growth rate in their CapEx, it's vastly outstripping the operating cash that they're generating. That's the problem. And they can't do it
Look at the
indefinitely.
revenue, Chris.
But
That's
but
completely
Steven,
wrong. All the
Steven,
CapEx that they're spending is a clear indication of a driver of revenue and a driver of cash from operations. Without the CapEx spend,
You're telling me that their businesses were not generating cash flow before that and they weren't growing
that's
at
not what I'm saying. What
Yeah.
I'm saying is that they are continuously increasing their CapEx, which we can see in this chart. When Apple didn't, I mean those are the numbers
right.
over the past 5 years. And then Apple is the only one that is barely moving the needle on revenue growth and cash from operations growth. And these four companies are still putting up a ridiculous amount of free cash flow because all of this is being funded by profitability. And without this expansion in CapEx, you would have never got these moves in revenue or cash from operations. They have made a decision to split the free cash flow between buybacks and reinvesting in themselves, because if they weren't reinvesting in themselves, you would not get this type of growth. Period. Full stop.
No, that's so wrong, dude.
It
Because
is
you're
not
telling me
wrong. These are the numbers.
no, it's wrong because if you look at it even before AI was around, you don't think that they were growing their operating cash flow like a crazy number before that? What was it? The AI didn't just mysteriously pop up in 2022 and their operating cash flow started to go up. They were generating operating cash flow growing at about 20 to 50% CAGR, depending on which one you're talking about, before AI showed up.
I'm going to give you a chance to take that back before I pull this up.
Pull it up. Pull it up.
Okay. We can go company by company. I only looked at one right now.
Go ahead. Show Meta's operating cash flow
Hold on.
going up.
We'll start with Microsoft.
Mm-hmm.
We'll go down the line. So you go back to 2017, 39.5,
Mm-hmm.
43.8, 52.1, 60.6 in 2020. And then we
Right.
start going 76.7, 89, 87, 118, 136, 147.
Right.
Big difference.
And what was the CapEx against that number? That's the question.
but they have to spend the capex to get that growth. You look at Meta, 2018 was 29, then 36, then 38, then 57, then 50, and then we explode to 71, 91, 107, and this year's not over. And yes, the capex is going up, but they have to spend that capex in order to drive these numbers higher. When
But
they were
Stephen,
only
at what-
spending,
But Steven, look at the capex growth that they have, and then look at the operating cash that they have, and just do a chart. You'll
so let
literally
me ask you this: would you rather the cash from operations be paid out in dividends and buybacks, or plowed back in as capex to grow the profitability? Because that's how they grew the businesses.
No, I'm totally in agreement with that. But at some point, the market is going to flip on them and say, look, we can't spend indefinitely on capex without getting free cash flow back in line. One of the reasons why Oracle is getting demolished right now is because their projected capex going forward is way higher than their current free cash flow. They've gone from positive free cash flow to negative free cash flow. Okay. At some point, Meta, Google, all of these guys are going to have to end up contending with that and saying, look, how much are we actually getting from this additional capex, and how much of it is actually profitable and not eating into our margins? I think the clearest indicator that they're trying to protect their margins right now is with all of their Blue Owl deals with these private equity firms, and same thing with Nebius and CoreWeave and everything to safeguard their balance sheet, to offload a lot of that capex on other people.
I mean,
know?
do they though? Alphabet is still doing 73 billion in free cash flow. Microsoft is still doing 78 billion in free cash flow.
What are they still doing? Why don't you do it like, okay, what has their historical free cash flow been for the last 5 years? It's been doing well, but it's starting to go in the other direction. It's going down.
So which one do you want? I'll build out any one you want.
Do Meta. Meta is the clearest example of free cash flow going in the other direction.
Battle Royale. Sorry.
Let's bring up a new one. First one, I'll get rid of the stuff. It's just the way that it loads in.
Yeah.
Should probably put what years. It's 2019.
You see why? Look at what Steven is doing. It took me 2 seconds to just pull this up on Fiscal AI. Let me just pull it up.
Yeah, but I like numbers, not graphs. And
they have numbers on there.
Meta's free cash flow
There
is still at 44.8, even
Before
though they
buybacks.
doubled.
Before buybacks. Before dividends.
Right, before buybacks and dividends. I have that too somewhere, as you know. Now, they doubled almost their capex, yet free cash flow is still 44.8 billion. But the cash from operations is 107, expanding. It is still expanding. We're seeing a huge jump over these 3 years compared to these 3 years.
Right. And the problem is they already said that we're going to be spending $100 billion next year. What are they going to spend the year after that?
150, it doesn't matter.
Are you kidding
It does
me right
not
now?
matter.
You can't say that. You can't say,
But how long does it not matter?
Because Chris, most
doesn't
people are
matter
looking
for-
at this for a 5 or 10 year investment. Nobody cares about 1 quarter to 2 quarters.
I get that, but for how long does it not matter, right? I mean, if it's a couple quarters, then yes, I agree with you. But the problem is at the moment, nobody knows that how long this is going to last. Is this capital expenditure phase going to last for 10 years? Because you think about it, that's, if they're outspending by say 50 to $100 billion a year, they're going to have to find somebody to fund all that. And then 2, very quickly in short order, you're going to end up in almost, $500-600 billion worth of debt. This goes on for a long time.
These companies are not expanding their debt
Yet.
As long as
That's the thing, Steve. It's a forward-looking market. We can't look in the trailing 12 months.
As long as they're funding it from their profitability, this is
That's
not
what we're
going to
saying.
matter.
That's what we're saying, Steve. There's no longer a run room. If you add in dividends and buybacks into that, there's no longer a runway where they can't not longer dive into debt.
They also don't have to buy back as many shares as they were.
Right.
Keep that
In
in
which
mind.
case now you'll get a multiple re-rating lower. What do you want? You want to
You
do
may
that?
not. Just because buybacks go down does not mean that EPS won't expand. That comes down to how much revenue they're adding and if they can keep the same margins.
I think you have this idea that they can keep spending unlimited amounts on capex and grow at an unlimited pace. I'm saying there's probably a point where these guys, and I'm telling you, the businesses themselves are already highlighting that they are not willing to spend nearly as much on capex as originally thought, because they're offloading their capex onto private equity, because they know that the margins that they're going to be able to get from all this additional capex is not going to be nearly as profitable as their services segment on the other side. So what are they doing? They're saying to CoreWeave and to Nebius, you guys can build the data centers, extract a 5-10% margin. We keep the 50-60% margin for the application layer that we sell to people. So
outside of Meta, has Microsoft, Alphabet, or Amazon offloaded to private equity?
All of them have. They're all doing it. They're all signing deals with these guys. That's why the market's been running up on CoreWeave and all these guys. That's why even you just said it. They have RPOs.
So which private equity firm did Microsoft sign up with?
Just pull it up. Hold on.
Which one did Alphabet sign up with? Which one did Amazon sign up with? Because I must have not gotten the memo, because the only one that did a PE deal that I'm aware of is Meta with Blue Owl.
Blue Owl
I'm not talking about Oracle.
Oracle tried to do that with Blue Owl. No, I know. They said no. They said no to it. So hold on one second.
So Steve, do you think that the growth rate which NVIDIA is able to grow is going to continue its current pace?
No. Why would anybody think that they're going to continue?
Then why? Then I'm curious as to why you're arguing with us.
Because this is not reminiscent of the .com bubble. NVIDIA is one of the largest.
We're not saying it's exactly like for like. I'm saying it's apples and oranges.
Largest companies in the market. For them to grow at 63% is not realistic. But that does not mean that they will not grow by 45 or 40 or 35%. And they're going to be over a $200 billion revenue company. The amount of revenue that they are doing and the growth in revenue is indicative of expanded build out. Same with Broadcom, same with what we saw from Micron.
But the thing that I think is worrisome to me with what you're stating is that you're basically saying that there's absolutely no way in any shape or form that NVIDIA has any risks.
That's
or
not what I
that
said.
any of these AI companies have any risks, and that everything is going swimmingly and there's always going to be ability to invest more capex. And so I guess that's where I'm confused a little bit. It's like,
let's use Microsoft because they're pretty much the most perfect company right now. Okay. Microsoft is spending blank check, and they've earned that right to spend blank check and fund it from their profitability. Everything that they are doing is making their current products better. They're upselling on M365 with Copilot. They're upselling on Azure with AI features. They're upselling on Dynamics. They're embedding all this in to Cosmos and to Fabric. They are the shepherds of the race, and they are allocating capital, building out what they need, and making their products better, and nobody's able to compete with them. Same thing with Amazon, same thing with Alphabet. So there is not a single chance that I will be selling any of these shares, nor would I not be investing in them because I am still buying shares of these companies.
So how long can this growth rate of this growth of capex continue?
This growth of capex can easily continue 3 to 5 years. Easily. At some point, we're going to plateau. And at that point, when we get into maintenance mode, you will likely see capex stall out, cash from operations explode, and guess what explodes then because you're not expanding capex? Buybacks, which will juice the EPS. At some point, we know that there will be enough data centers, and it will just be replacing GPUs or that are broken or adding new ones, but you don't need a bigger footprint. I don't know when that is. People have different projections. I think that's 3 to 5 years. But what's not going to stop is these companies getting bigger. And this is how their C-suites have said that they are going to increase revenue. So it is crazy for any of us to say that these stewards and titans of industry are incorrect.
Well, these stewards and industries of titans of industry also overcommitted to hiring during COVID and then ended up getting smashed afterward and then had to rearrange everything and get back to some level of capital discipline. That is what the market does. These guys, no matter how big a company gets, never underestimate their what's the word, their ability to overspend during good times and then have to pay for it later on. And so all I'm trying to say is, even you, Steven, your timeline may be 3 to 5 years. You just acknowledge that at some point the data center spending will come down, in which case companies like Oklo and all of these other guys, they are going to get hurt.
Good.
Right?
They should be a $500 million company. They don't matter to the market.
Right. So then the bubble will probably end up bursting. Your timeline is 3 to 5 years.
There's not a bubble. There are pockets of the market that are expensive. Oklo shouldn't be where it is. Palantir shouldn't be where it is. Freaking, I can keep going on naming companies that shouldn't be anywhere near where they are. Palantir is a $60 stock.
Isn't that the definition of a bubble?
This is not a bubble.
On
This
one
is
hand,
not
you just made the statement that there's a lot of companies that are not where they should be. And now you're saying, no, there's not a bubble.
There's not a bubble. Companies get expensive in every market, and some companies overshoot things in every market. The difference is that if Oklo and SMR and those companies, CoreWeave and Nebius, go to zero, they're not in S&P. Doesn't freaking matter.
You're talking about Microsoft. All these guys have equity investments in them. They're putting up so much money into these companies. You're telling me if OpenAI went BK, that or got re-rated much lower, that wouldn't impact Microsoft's balance sheet?
I didn't say OpenAI. I said CoreWeave and Nebius.
Right. In which case, who owns parts of CoreWeave and Nebius?
Intangible
NVIDIA.
assets. Intangible assets on the balance sheet.
But once
Intangible.
again, that's the problem. Then you've got an entire giant customer who's a buyer of chips is going to falter, in which case now you've got growth rate in NVIDIA going from 100% down to 20, 30%, in which case and NVIDIA right now is about 10% of the market cap in the S&P 500.
Are you worried
Not
about the
10,
growth
about
rate?
7.
Are you worried about the growth rate in NVIDIA?
I think eventually the growth rate will come down. It's not going to
Yeah.
be unlimited growth forever, in which case
it's
now the
not.
multiple will
I think that
contract.
the build out's another 3 to 5 years.
All I'm saying is I am with you in that we can see growth ahead, but this is not the time where you want to be quote unquote heroic and not be somewhat hedged against a possible downturn, even if it's just a sentiment related downturn. That's not a business related one. Very similar to what we saw during Liberation Day, where the market went down 15, 20% based on some commentary, right? In which case you had the capital to deploy to actually make a really good return on the back end of that. I mean, is that a fair statement to make?
Yes, because a downturn is inevitable. A retracement is inevitable. It's likely going to happen in 26. We're likely going to see a 5 or 10% retracement at some
But
point.
then you're saying there's no bubble either.
That's not a bubble. If we go down 80%, that's a bubble. Well, how much do we go down? How much do we go down the .com? 80%.
No. Okay. So, all right. So let me rephrase that. I agree with you that I don't think we're going to have the crazy tech bubble kind of popping that we saw. I think the market can easily do 15, 20% down. And if not, we could probably see a more than a few years of underperformance in the market, right? The question is, how are you going to hedge against it? Like we've made a lot of money over the last 2.5, 3 years. You don't think it's smart to, at least to some degree, while the valuations on everything are at near peak levels, to kind of at least hedge against it?
So,
I mean, look at the forward PE and CAPE ratio right now. They're literally 40.
on which ones?
No, on the S&P.
Okay, so here's what I will tell you. And nobody do what I am saying, because this is just me personally, okay? This is just me. I am not touching a single thing. I have a lot of money in the S&P 500. You will not get me to sell a single share of it because you know what? I can withstand a downturn. I can withstand a retracement. A retracement is inevitable, but every single dip and every single retracement and every bear market gets bought. I'm not playing the game of trying to get out and get back in. I don't care. I'll let the little dividend that I get from the S&P roll back in and buy me more shares. My Meta shares, no reason for me to get rid of them. Amazon, no reason for me to get rid of them. Same with the other ones. Now, as far as what's going to happen next year, I do think 5 or 10% down at some point, but we still finish the year at 8,000. I know that I can't time markets, but even if we get a bear market at some point in the future, it'll get bought up and it'll reverse to the upside pretty quickly. What is on the horizon that is scarier than COVID? Nothing. Nothing. Think about the Ukraine-Russia war. How quickly did it snap back? Think about Liberation Day. How quickly did it snap back? As long as the biggest companies are driving the market with expanded guidance and expanded EPS, any retracement is a buying opportunity at this point.
Share the screen real quick.
And 20% down, not a bubble. That's a bear market.
Yeah.
Bubble's 80% down because that's what .com was. Actually, I think Nasdaq was 87%.
Yeah, but then you also can run into this point where, you know what, you don't need a sorry, I'm sharing the wrong screen. You don't need a massive correction into the downside, like a move down. You can have a market that languishes for a prolonged period of time too, right?
Sure, of course.
So like if you look here, this was the year.
Oh, not the Shiller PE. Just do what the regular PE of the freaking S&P is.
Even if I did
trading
that
at versus historical.
Even if I did that, that's still 31. Literally the last time.
Is that scary though? That's not scary compared to where we are. We're in a different market than the Industrial Revolution. This is a market led by tech, not industrials.
Dude, 30 times earnings is still high. Okay. I don't care what you say, Steve. I get it. You're going to say, well, look at the PEG ratio. Look at, like the growth that we currently have is much higher than in the past. But dude, you can't tell me that you're not at least going to try to hedge some of this stuff.
No. For what?
Right. Yeah, let's ask that question, Chris. So, really healthy debate, right? But I think we're talking in circles at this point. Yes, I am reading chat, Chelsea. So the question I have for you is what are you doing to hedge any potential downside? Are you selling calls and buying puts? What are you doing to be able to protect yourself to the downside if you so call? Because I personally am willing to let my shares go unhedged to the downside. I'm fine with that. I don't really like to buy protective puts. It's never where I've been, but I know in the past you have. So I'm curious, like, are you doing any costless puts to help yourself to the downside, or what's the thought that you're doing?
As of right now, I have nothing that is hedged outside of like a few positions where I have spreads instead of just naked positions. And that's exactly what I'm looking for right now, a way to not pay a shit ton in premium in order to hedge myself so that, like, it's almost like I don't mind making 30, 40%. But at the same time, if it costs me 20%, then really what am I doing here? You know what I mean? Mm-hmm. Like I need it to be so overwhelming in my favor to make it work for myself. So I don't mind risking, let's say 5% of the portfolio to protect, against a 20% run up. You know what I mean? Like if you can get a 20% upward move and all it cost you in terms of insurance was 5%, then yeah, I'm willing to do that because I'll still make 15% on it and I can sleep well at night. So that is the key that I'm looking at right now. And the question is, how do you do that? Well, the only way that I can think of is you find the most overvalued piece of shit company and you buy puts on it. But the problem is they're really expensive. So you got to find a company that no one thinks is going to falter and buy some puts on that thing long term and then see where things go. So,
but for example, I mean, I'm sure that you could look at your NVIDIA position and potentially do costless collars on that allows you, not costless collars, but costless puts that you'd be able to potentially use in case it starts to go in the
The
wrong
problem is
direction.
the problem with Nvidia is that they have enough cash flows that even if the stock went down a somewhat material amount, they would just be able to buy back shares and support the stock price, right? You got to find the company that's not going to be able to survive that. And that could be your hedge, where it's so ingrained into the AI ecosystem that people have assumed that there can be no issue. And then when that company starts to fall, basically that gain from that can really hedge you well against it. You know what I mean? Hedge your
Chris,
portfolio.
let me ask you this. The Contra fund that you have, are you planning on exiting that anytime soon?
No, I'm leaving that. It's diversified. It's
Okay.
diversified. Yeah.
Okay. So for people who have a significant amount of money in a diversified fund, whether it's a Contra fund or an S&P 500 index fund, is there any reason to hedge against that?
Not against the S&P 500, but against the
Exactly.
AI wave. Yeah, there's definitely ways to do that.
So keep in mind, everybody in the chat, the reason I asked Chris that is because I have repeatedly stated I have a lot of money in the S&P 500, and every individual equity that I invest in, I expect that to go to zero. In all seriousness, not taking Matt Money's line away, but everything that's in the market in individual companies, I know can go to zero. And I am fine with that because I have cash reserves. I have a large amount in the S&P, and those are my hedges against myself being stupid. That's why I'm not looking for puts. I'm not looking to play that game. I make investments for 5 to 10 years out, and I can withstand any downturn and sleep well at night, and I don't have to do any of that stuff. I'm not, the way I'm diversified, I'm good.
Can't believe you're stealing my line, Steve.
Stealing your lines.
Hold on.
I might as well just leave. I got nothing else to do. You know, what am I doing? I'm just joking. No, I'm with you. To me, I like to talk about the short term macroeconomic and what I think is happening, but I'm with you, Steve, in that respect that I look at things where I think they're going to be in 2030, 2035. There are some things that I look at potentially as macro so that I can make entries, like the crypto winter thing, and how I think that there's a huge possibility that I might make a big move into something like a Kraken, Coinbase, BMNR, maybe even MicroStrategy in the coming 12 months when things really start to cool off, because everyone is talking shit about them and how they're going to zero pretty much with everything that's going on. I think that we have yet to see a crypto winter. So in that sort of respect, I try to keep up with the macroeconomic environment, but I'm with you in the respect that I'm a long-term believer in a lot of the companies that I hold. And I'm not sitting here saying I'm going to sell Palantir because of the fact that it's super high up and overvalued. Because to be honest, you don't know where things are going to end up. It could end up in a stag. It might just be stagnating.
And Matt, I'm going to
It could
cut you
pull
off
back.
just for 1 sec. I apologize. I just want everybody in the chat to know that we're not arguing. Okay, we're having a discussion. We are not.
We're arguing, but we're friendly
The
arguing.
three of us are
I'm
very
livid,
good
Steve. I'm
friends.
going to flip this table.
Like we're not arguing the way that you guys think. So just
Yeah.
want to put that out there for the amount of
Where's a
time.
chair so I can knock it over?
The best part about
Matt,
it is the
keep
only
going.
people you can truly argue with is your friends. Like if you
Exactly.
don't like the other person, I could very easily just be like, yeah, okay, Steve, you're right, whatever. But see, that means that we're not really friends. The people that you can argue with, you feel comfortable enough to actually speak your opinion about.
Oh, 100%.
And there's a lot of things that me and Steven agree on, and there's things
There's
that
things that we
disagree.
don't, which is fine.
My biggest fear, guys, when it comes to this is we get something similar to this, okay? Where you literally had the .com bubble, S&P 500 got to 1,500, and you know when the S&P got back to the 1,500 level again? In 2007. You got 6 years of zero growth, and then you had the what is that thing called, the Great Financial Crisis, and things went back, and the S&P 500 was back to 1,500 again. So literally for 13 years, if you had bought at the market top or even remotely close to it, you got zero returns, zero compounding. Right now, everyone and their mother is always like, yeah, just buy the index fund. Just buy the index. I think there's a goddamn index bubble at some point. Every single asshole investor right now is all preaching the same thing. I'm just going to buy the S&P, including you.
No, it's an easy hedge. But I do agree with you that we've never seen this much of a concentration. And part of the reason why I believe NVIDIA, Microsoft, and Apple have such huge market caps is because of index investing. I truly do believe that.
Mhm. I think we're also on the same page that CapEx can't go up forever. Whether or not it's in 18 to 24 months or whether it's in the 48 to 72 months that Steve is thinking, we all agree that there will be some sort of point at which the CapEx cycle does sort of end. What happens from that, whether you call it a bubble, whether you call it a slowdown, whether you call it a leveling off period, I think we're all in some sort of agreement, and it'll be fun to update this because I feel like it's going to be a constant conversation until we get to that point. My question for you both, I don't want to be disrespectful of Amit and him being on.
Yeah, I texted him, Matt, that I was planning on ending at 3:45, but we were in the middle of this discussion.
Very good. Do we want to give a word for his for everybody in our chats to carry over to him?
Yeah,
What are we thinking?
so let's end this we're going to end at 4:15. We'll end in 6 minutes.
Sounds
We'll
great.
let each of us get our last thoughts out and then head over to a midstream and spam them with code red.
Code red.
Yeah.
All right, I like that.
So Matt, why don't you go? What are your last thoughts? Give you 2 minutes.
I don't know. I think that the easy money has been made in terms of AI and where we're at and with this data center thing. I'm cautiously optimistic that things might be going the route that you're thinking, Steve. But at the same time, there's something about where we've been since December 2022 to now, where we've just been on this monstrous run. And I have an inclination to agree with Chris on a lot of things, like the Oklos of the world, and I don't know anything about Oklo, but I'm just saying the SMR space and a lot of these other auxiliary second or third derivative of these AI plays, I think will hit some sort of wall at some point. And believe it, whether or not you think it'll actually impact the S&P, I believe it will. And whether that happens in 2026, 27, I don't think we're going to go into 2028 before seeing something like that where we see a true meltdown. I think November was we saw a slight bit of that with some of those companies being down, and some of them still haven't recovered. So maybe I'll eat my hat, and maybe those things never will. But I'm cautiously optimistic. We've seen a lot of other companies like the space industry and many others have started to rebound, and some of them will eventually show up within the next 12 to 24 months as not being able to stand on their own 2 feet. And with that, I think you will see some issues with what's going on. And that I think I'm in agreement with Chris. So when you take over for your final statement, please correct me if I'm wrong. But I agree with Chris. Like the free cash flow, if you include dividends and you include buybacks, has been completely diminished by a lot of these Mag 7 companies. And to me, once again, that leads to a thought that you can't keep going forever. Now, some of these companies can go into debt because some of them have very little. And so I agree that you have an opportunity to run at a deficit for some time, but that's not a forever thing. And I think eventually, if you do cut buybacks, you cut dividends, etc., to be able to fund these things, you are going to piss off some people, and that's going to have a re-rating on the multiple. Like Chris, I think said I think he said that, which I agree with 100%. And so that's where I'm at. I'm still bullish on the market. I'm not selling anything. I don't buy puts. I'm long term, 2030, 2035 is what I do my analysis on a lot of companies. Those are my check-in points. And I'm very cautiously optimistic that all those companies will do well. But in the meantime, it doesn't mean that I don't think that there's going to be a 22-like event, like where you have this massive, multiple spike of revenue coming out of 2020, 2021 with COVID, and then a slow drawdown. Is it going to be like 22? Is it going to be a V shape? I don't know. But I think there will be some sort of scare associated with this massive capex investment. And the thing that I always go back to is what happened with Amazon. Amazon was way overbuilding these warehouses, and then the world started opening up again, and they said, "Oh crap, we hired way too many people. We got too many warehouses." Now they've obviously gotten back to that point where they're able to utilize those warehouses, but they paused it for a couple of years. And they recognized that the capex that they were doing was out of hand, and they pulled back and said, "Hey, we need to get back to efficiency, not capex overspending." And I think that at some point within the next 12 to 18, maybe 24 months, you see that.
Good take, Matt. Chris, your thoughts?
There's a limited amount of ad dollars that exist. Like, okay, so the business models, a lot of these companies, you can dissect them individually. Microsoft makes their money on enterprise, right? Selling software to the enterprises. Amazon makes their money selling AWS services mostly to to enterprises. Meta and Google make majority of their money from ad revenue, and some also with enterprise client for Google. There is a limited dollar amount that the world can support on expenses with these guys. The amount of money is somewhat limited in what they're going to be able to grow at. So even if, let's say, you have this idea that they can spend AI capex like crazy. Oh, dude, someone just donate. Hey, what's up, Derek?
Eric, that's not even real. That's insane, dude. I don't even know what to say.
Thanks, Derek.
Is the man.
Appreciate it.
I'll have to give some of that to Chris for Christmas. Thank you so much, Derek. That is like, I saw that and I threw my hands up. I had no idea. That I much appreciate it. I'm speechless. Sorry, Chris. I didn't mean to interrupt that. I just
if you want, drop that into the portfolio and buy more VG, bro.
Good point. Yeah, I'll do that. I'll put that in there. Yeah.
The point is at some point the businesses have to also contend that how much more can Meta optimize their ad spend before people say, wait a second, you already collected majority of the ad spend that's out there between you and Google, right? So naturally, you're going to run out of revenue opportunities at some point. Now, that doesn't mean that they're not going to grow. It just means that they're not going to be able to grow their top lines by 50%, 30, between 30, 50, whatever percent that they're growing at right now, while they're getting a lot of the benefits from AI. At some point, it tops off, in which case now the companies go into optimization mode. So they're going to say, you know what? We don't need to build as many data centers. So what happens? All the companies that are data center related and data center centric, right? Like Vertiv builds right now. Vertiv's got a crazy build out because of all the demand for the data centers for cooling of these things. If at some point the data center spending starts to slow down, now all of a sudden Vertiv goes from high growth to, hey, wait a second, we're just an industrial. That's it. And they start going the other way. GE Vernova, same thing with the energy thing. A lot of these other tertiary parts of the market that have benefited significantly from the AI boom are going to end up taking a tumble. And does that mean that the S&P is going to crash? Maybe to a certain degree, but I think it's more likely that we see what we saw in 2000, which is you're going to see a stagnated market for like maybe 6-7 years while the market catches up. In which case, right now is a great time to understand how fixed income and bonds and everything else works, because this way, if you've got this low growth scenario, if you've already hit that 7-figure mark, the goal should be to protect yourself against any major downturns in the future, especially if that is the income that you're going to be relying on to basically retire on. So if you're like, let's say 50, 60 years old, you need to be very cognizant of where we are in the current market and the risk that you're taking by being in the equity markets while the market's at literally crazy levels of valuation. If you're 20 years old, if you're an Amit, you can survive 13 years worth of zero returns. Because you know what? At the end of that, you'll probably still do way better, right? So I would say, depending on where you are in your age cycle, that is where you should be trying to figure out how to invest. I would say if you're older, right now is to not take nearly the amount of risk that you have. I am right in the middle of all of this. I'm 40. I've got 20 years to go before I really need any money to retire, but I'm not 20 years old where I can survive, or not survive, but basically start all over again, where I don't want to start all over again. To be honest with you, it's a pain in the ass to start all over again. Don't want to do that. So I'm going to make sure that my portfolio is balanced in a way where, yes, I want to make money, but I'm not going to like risk my well-being to do it.
All right. So here's where I'm at. Started running the numbers when Matt and Chris were talking, and I'm going to make some predictions. These probably won't happen. I am predicting S&P 7,000 this year, S&P 8,000 next year, and by the end of the decade, so by the end of 2029, we hit S&P 10,000. Does that happen? I don't know. It could. And if it does, that would mean that we go up 44% from here. Maybe it happens, maybe it doesn't. The way that I'm looking at things is on a forward earnings basis, the largest companies look extremely cheap. I have increased my duration for the build out. I originally thought it was going to be 18 to 24 months. And as the new data comes out, it looks like it's going to be at least another 3 years. And there's no indication that maintenance mode is going to be a deceleration. There's also no indication that it's going to flatline. So we need to know what maintenance mode looks like. But having a large sum in the S&P is my hedge against other things. I'm also not in a lot of speculative companies, and I am in a lot of old school companies like Verizon, real estate like Realty Income, et cetera, et cetera. So I do have residual income coming in, PDI for bonds, that type of stuff. But there's no other place to really put money other than the market. Most people are putting into an S&P or a total market index fund every 2 weeks, or a target date fund, which is then predominantly putting into the largest companies in the market. And as long as earnings are continuing to expand, and my thesis could change if the data changes, but right now there is nothing ahead of us indicating that these companies are not going to continue to get bigger, especially with AI and robotics coming online. So for that reason, I'm not in high beta names like an Oklo or that type of stuff. And I am very more skewed toward an Apple, an NVIDIA, Microsoft, Meta, Amazon, Alphabet. Most of my money is in there, other than a Palantir or a SoFi type thing. But I think we're in good shape. I think when you look at the economic projections, we have inflation going down, we have rates coming down, we have more GDP growth than what most people thought. And a lot of people did not think the Fed was going to project GDP growth over the next 3 years, every year consecutively. The chances of a recession at this point, based off of the economic indicators, are much lower than they were the prior week. So unless something in the economy changes, I do think that we are going to have a continuation of the bull market. That does not mean that we won't get a retracement. I am fully prepared for a 10% retracement next year. I don't think we go into a bear market. I also don't have a crystal ball. But if we get a 10 or 15% retracement, that shakeout is healthy. And I hope a lot of leverage gets shaken out. And I hope a lot of people that only go into high beta realize that sometimes you do need to get diversified. And I know Chris, Matt, and I are very diversified. We all have Chris with the Contra Fund, Matt and I with the S&P 500 funds. But those are all hedges. I don't get as technical as Chris because I don't really want to go down the road of trying to find the puts and that type of stuff. But at the same time, I can completely understand why Chris does it. He's more active in the markets than me, and his strategy works for him. But I think that everybody needs to take a step back, realize that we're not arguing. We're having a constructive conversation. We don't hate each other. And sometimes friends can disagree on things. We are all in a lot of plays together. Some plays we're in alone, and that's fine too. But these are the people who we all bounce ideas off of privately. So I would say that don't read anything into this. This is not a fight. And, this isn't going to be the last time that we disagree on something. But we've all made a lot of money together, and I believe we're going to continue to make a lot of money together. So
Exactly.
that's
all
all.
That's all that matters. Right? You got to make that money.
Yeah.
Make that money.
Look, you need a core of people that you can talk about investments with, and you need a core of people you can bounce ideas off of, because not every one of your ideas are going to go correctly. And I would hope that if I'm really doing something stupid, somebody's going to say to me, listen, that's really not a good idea type thing.
Yeah.
So, that's where I'm at with this.
Yes, sir.
So, all right, everyone, please go watch Amit's stream. I know they're doing Technical Tuesday. Say code red in the chat, and we'll see everybody later.
Code red, code red.
Code red.
Bro, I hate Technical Tuesdays. Can we just take 2 seconds and just talk about it really quickly?
What?
Techno
There-
Tuesdays. What's wrong with
Because
Techno
I feel like Technical Tuesdays is like this weird, like voodoo science, bro. It's like pseudoscience. It's like, look, it's like wedged this way for like 3 days. That means that it's definitely going up. And I'm like, what? Like, I mean,
Yeah, but
I
if you
try
can
to.
make money doing it, I mean,
I mean, I
listen,
could. Yeah.
it's not for me, but if you can make money doing it, more power to you.
I mean, I get when things are oversold, when things are overbought. I don't know about like these patterns, like pattern recognition and stock price movements and stuff. And then like Donald Trump comes out with news and says, I'm gonna tariff China 80%. And now all of a sudden Technical Tuesdays just turn into terrible Tuesdays. You know what I mean? Like, I'm just saying, like, even me, I'm a macro guy, right? So I'm looking at things from a macro lens, and even I get to call shit wrong because guess what? The picture changes every other day, especially with this current administration. So this whole notion that you could theoretically predict the markets using squiggly lines on a computer, it just feels weird. That's all.
I'm
It's why I don't do technical analysis.
I hear what you're saying, but I think the thing with technical is like it's more about helping you give yourself stop points, and it's not to say that it will work, but I think what it is like if you think it's going to go in the wrong direction, then you could set a stop loss, for 1 to 2% and above or below whatever sort of price point you're talking. So, I mean, I don't necessarily agree with it. I don't follow it. Sorry, I shouldn't say that. It's not something that I do because I don't follow that. I'm more of like a long term. Where do I think this thing will be in 5 to 10 years? But I can see where the pivot points are, and I don't think that anybody ever thinks that it's like gospel. I think it's people utilizing it to give themselves a slight advantage, because I do think that the Fibonacci piece works a good bit coupled with other things. You can see where things are selling off oversold, etc., to give yourselves a slight advantage. But to me, it's just my brain doesn't work that way. I think long term. So I see a lot of people that have had success with it to be like, hey, on this pivot point, yes, it might break down. It might not work, but it gives you at least some sort of place to hang your hat to say you're at least wondering if it's going to pivot off of that or not. And it can be useful. And I've seen it, work in great areas, and I've seen it not work in great areas. So,
Yeah, I mean, the only technicals that I tend to use are ways that I know that I can use it to get better entries, exits, but not necessarily like go crazy with it, right? So it's like, oh, look, RSI on the 1 year dropped to like below 30. Okay, it's oversold. You know what? What are the fundamentals of this company? Are they improving? Are they deteriorating? And if both of those things line up, then, it works out. So it's kind of like, but my thing is sometimes the technicals are too short to make a case that this could be useful. So it's like next week it's going up because it hit this support level. And I'm like, what are you doing? Like, is this just based on like vibe? Like, oh, look, the vibe is that it's gonna retrace. I don't know. Maybe I need to do more research on technicals. But every time I watch it, I don't know. I just don't like the it feels just like pattern recognition, and I'm like, and to some degree, there are ways to actually beat the market using technicals, but there's this if you guys and everyone in the chat, if you guys want to look this up, it's called Markham indicators. I think that Renaissance Technology with Jim Simmons, they created an algorithm that basically helps understand how one industry relates to another, that relates to another. So these indicators that are like hidden around the market, that if you have the access to the right data, it will actually give you an indicator of where certain stocks will go and which direction to follow the market. Have you heard of that before? Markham indicators? I think it's Markham indicators. No? That's one of the things I want to like research and see like what are some of the things. So let me give you an example. It's like the weather in Colombia. What does the weather in Colombia have to do with Burger King? Like, does it make any correlation whatsoever? No, it doesn't. But I don't know. There could be a special ingredient in Burger King where their supply chain is heavily connected to Colombia. And now all of a sudden, if Colombia is having an economic problem, that supply chain breaks down, and now Burger King doesn't have the supplies that it needs. And now the next 2 earnings that it's going to have are going to be poor yielding because the products that they have are going down. So it's almost like these figures that are hidden out there, like natural gas. Like, we all know plastics and chemicals and everything else are heavily dependent on natural gas, right? So if you could figure out, wait, then there was going to be a spike in natural gas prices, you could tell that the price of fertilizer was going to skyrocket. And so companies like Mosaic did crazy amounts of revenue growth because the price of fertilizer absolutely skyrocketed. You guys remember that during Russia war, Ukraine? Remember? So it was like, what does the price of fertilizer have to do with natural gas prices? So when Russia invaded, people thought, oh, natural gas prices went up. The real hidden jewel was actually buying the infrastructure to build that fertilizer, you know? So it's like things like that. But it's a lot more complicated. But that's a really fun and interesting way that investing and the Medallion Fund by Renaissance has just killed it for like, I don't know how many years that thing's been around. So, yeah. All right. That's
On
it.
that note, we are done. If we don't talk to you, have a great Christmas. Enjoy the holidays.
Markov models. Sorry, I said the wrong thing. Markov models. Thank you for the person who corrected me in the chat.
And we'll see everybody later.
Putting Amit's thing in the chat for everybody.
Beans McGee, join the chorus, brother. Join the chorus of people. Good times.